in 2006 and was then called the Catamount Healthcare Assessment. While the legislature was considering an increase this past spring in the amount of the assessment, and we started checking with a number of our members about what the impact would be, we quickly learned that many employers were still confused and may perhaps filling out the assessment differently, in some cases overpaying, in some cases underpaying. And we thought the webinar would be a good opportunity to once again go over how the assessment for uncovered employees are covered, what does it mean, and how are part-time employees handled, and et cetera. So we are very fortunate today to have two individuals from the state who can help us walk through the different scenarios and help you calculate the employer health care assessment, as well as cover some of the issues related to the large employer over 50 federal penalties that will kick in for those employees who have uncovered employees as well. So at this point, I would like to introduce Devin Green, Special Counsel for Healthcare Reform, and also Tracy Phillips from the Department of Labor and Unemployment. So with that, Devin, I will turn it over to you.
Great. Thank you so much, Jim. I just wanted to say quickly, I'm Devin Green. I'm Special Counsel for Healthcare Reform. Is everyone still seeing my screen okay?
No, but I might have done something. Sorry.
Oh, no. Let's see. It should be, cannot take control. Okay. Okay. Does that work for everyone?
Yes, it does.
Okay. I'm Devin Green. I'm Special Counsel for Healthcare Reform, and we also have here Tracy.
Hello, everyone.
So that's Tracy Phillips. She's from the Department of Labor, and we will talk a bit about the employer assessment / healthcare fund contribution and the federal shared responsibility payment today. So first, we're going to dive into, oh, and one thing that I should say is that if you have questions, please type them in your questions section in the menu. And then you'll see questions. So if you type that out and submit it, we will get that, and we will be able to answer your questions at the end. So feel free to do that at any time, and then we will address your questions at the end of the program. So as Jim mentioned, the employer assessment / healthcare fund contribution / catamount assessment is a Vermont-based law, and it has been around for a number of years now. It was established in 2006, and it was established to provide a fair and reasonable method for sharing healthcare costs with employers who do not offer their employees healthcare coverage. And right now, the way this works is it is done along with the unemployment taxes. So if you have, if you're filling out your unemployment tax sheet, it used to be a sheet of paper. Now it sounds like the Department of Labor has gone digital, but when you fill that out, you also fill out the employer assessment when you're doing that. And as Jim mentioned, originally the employer assessment was set up to pay for, to help pay for the Catamount program and other affordable programs. The employer assessment continues to pay for affordable health care by being applied to the premium, the Vermont premium subsidies and the cost sharing subsidies. Right now, the employer assessment is $140.84 per uncovered FTE per quarter. And the big question when we're dealing with the employer assessment is determining the number of uncovered FTEs. Once you have the number of uncovered FTEs, then you just apply that $140.84 amount to each uncovered FTE, and you'll have the amount that you're supposed to pay. So if you're just looking at it, you will take the total number of hours worked by uncovered FTEs, divide that by 520, and subtract 4. So that's sort of the easy way to think about it, but it gets more complicated. The Vermont employer assessment is not the large employer shared responsibility payments under the Affordable Care Act. We will get into that in the second portion of this presentation. And it's possible that large employers may have to pay both the large employer shared responsibility payment and the federal employer health care fund contributions. So folks might think, oh, there's this Affordable Care Act penalty. Maybe that substitutes my Vermont payment. It does not. You may have to pay both if you're a large employer, and we'll touch on that a little bit later. So when you're trying to figure out exactly how much you should pay and sort of apply it to a real-life scenario, there are a couple steps that you should take. The first step is to figure out if you have 5 or more employees. If you do not have 5 or more employees, you can just stop here. You are all set. You're exempt. So you would report 0 on the quarterly report. If you do have 5 or more employees, then you go on to the next step. And the next step is, do you offer health care to at least some of your employees? And if you do not offer health care to at least some of your employees, then stop right there. All your employees are considered uncovered, and all the hours worked must be included in the FTE calculation on your report. So you would take all the hours worked and divide by 520 and subtract 4 to get the total FTEs that you have, and then you'll apply that $140 amount to the total FTEs. And that's even if all your employees have healthcare coverage from some other source. So if you have a business and all your employees are married to teachers or state employees, and they are all covered or they're on Medicare, if you don't offer coverage, this still applies. So if you do offer coverage, then you go on to figure out if you still might owe something. So if you offer coverage, have your employees fill out a declaration of coverage form. And so if your employee fills out the declaration of coverage form and the employee is on your plan, or if the employee is not on your plan but is covered by healthcare coverage other than Vermont Health Connect or Medicaid, say your employees who are married to teachers or state employees or other folks who have coverage, then that employee is considered covered, and those hours are excluded from the FTE calculation. On the other hand, if the employee fills out the declaration of coverage form but is covered by Medicaid or a non-group Vermont Health Connect plan, which is an individual plan, a non-employer plan, and is also not a seasonal or part-time employee, or if the employee has no coverage, even if you offered coverage to the employee and the employee turned it down, then that employee is considered uncovered. All hours must be included in the FTE calculation. And so it's entirely possible that you have offered coverage to your employees and there's one or two people who just turn it down. You will have to count their hours and potentially pay for those folks. Now, if there are under 4 people who turn it down, then you won't have to pay for them. But it's possible for you to offer coverage and still have to pay the employer assessment if the employees don't actually take coverage or don't have coverage or are on Medicaid or a individual Vermont Health Connect plan. So those are the employees to whom you've offered coverage. For those who you have not offered coverage, the next question is the employee seasonal or part-time? Seasonal is defined as 30 hours or more for a job that is 20 weeks or less. And part-time is less than an average of 30 hours per week with total hours fewer than 390 per quarter. So, if you've offered coverage to some employees and not offered coverage to others, but those that you did not offer coverage to were actually not seasonal or part-time, they were technically full-time because they worked that 21st week, then that employee is considered uncovered, and all the hours worked must be included in the FTE calculation. So say you've offered coverage to all your full-time employees, but you have not offered coverage to your seasonal or part-time employees. Have them fill out a declaration of coverage form. And if the employee is covered by health care coverage other than Medicaid, even if that's a Vermont Health Connect individual plan, the employee is considered covered. So those hours are excluded from the FTE calculation. If the employer is covered by Medicaid or the employee has no other coverage, then the employee is considered uncovered, and those hours must be included in the FTE calculation. So unlike, one thing to point out here is that if you offer coverage to your full-time employee, but the employee has a Vermont Health Connect plan, individual Vermont Health Connect plan, you will still have to count that person's hours. But if you do not offer coverage to a seasonal or part-time employee and they have a individual Vermont Health Connect plan, then you do not have to count their hours. It's a little bit complicated to think about, but the main reasoning behind it was that the legislature felt that if full-time folks were going to Vermont Health Connect to get coverage, then the coverage the employer is offering is likely not very good, and so the employer should have to make a contribution because of that. And the legislature thought with the seasonal and part-time workers, those workers are traditionally not offered coverage in employment situations. So if they are getting their coverage through Vermont Health Connect on individual plans, then that's okay. But the legislature also felt that employees getting coverage through Medicaid should have a contribution from the employer, because those folks have very low income, and so that's why they're on Medicaid. So that's the employer assessment, and I think what I'll do actually is just see if we have any questions right now.
Devin, can I start off with a question?
Sure.
I'm fortunate that you allowed me to talk, so I don't have to type it in. But real quickly, one of the questions that we've gotten from time to time is a retailer that has a couple locations that has them set up as separate corporations. They may be different names in some cases, and there are separate reporting entities for purposes of unemployment insurance. How are they treated in terms of the calculation in the four-person exemption?
That is a good question. And Tracy, if you have the answer, feel free to jump in.
If I understand you correctly, Jim, each entity has its own Vermont labor employer ID number, and they're set up as different entities. And so when they go in electronically to file their contribution report, they are considered a separate entity, even for the healthcare reporting component.
Okay, so the caveat is, or the key is, they have to be separate reporting units for purposes of your Department of Labor ID.
Correct. The
okay,
contribution reporting. Yep.
Right. Thank you.
Okay. I am actually not seeing any other questions, so I will move on for now. We can always come back and talk about the employer assessment some more. Tracy, did you have anything that you wanted to add before I moved on?
No, I think that you covered it very well. I think the only thing that I would add, I mean, it's implied, but maybe to say it out loud, for the situation of seasonal and part-time employees, if the employee is not covered, if they don't have any health care coverage, they would still be considered uncovered, regardless of the scenarios that we've talked about, or that Devin pointed out when they're covered. Devin spent quite a bit of time going over the distinction between part-time and seasonal as it relates to whether or not they're considered covered or uncovered. But those circumstances evolved around whether or not they had Medicaid or whether or not they were part of the Vermont Health Connect plan. But the bottom line is, for seasonal and part-time employees, that distinction is specific to when they actually have some sort of coverage. When they are not covered at all and the employer does not offer coverage, and or if the employer does, then they're considered in the uncovered category.
Yeah,
Tracy,
that's a great point.
Tracy, can I ask one question for you on the uncovered employees? What if you do not have a declaration of coverage form on an employee that is not on your insurance plan, or you have not updated it in over a year? How are they treated?
We would, during an audit, we would consider them uncovered.
Okay, so even though that part-time employee may have coverage, but if they haven't filled out a declaration of coverage form, you wouldn't know that, and therefore the employer has to treat them as uncovered. Is that correct?
Right. We have to assume uncovered unless otherwise properly documented.
Okay. Thank you.
Yeah, so I think it's a good idea whenever you offer any sort of coverage to just give out those declaration of coverage forms so that DOL will have the documentation. Okay, moving on to the large employer penalty, otherwise known as the employer shared responsibility payment. This is, I put a big old map of America because while the employer assessment / healthcare contribution is specific to Vermont, the employer shared responsibility / large employer penalty is across the nation. It's under the Affordable Care Act, and so it applies outside just the state of Vermont and is federal law. And I think this is a great go-to quick sort of reference to figure out whether or not you may be subject to the penalty. Of course, all large employers are, I would counsel all large employers to get more information and to talk with attorneys and HR folks and tax preparers if you find yourself in this situation. But just as a quick reference, what you can do is figure out if the employer has, and this is for 2016, at least for 2015, this is in effect for this year, does the employer have at least 100 full-time equivalent employees in the previous year? So for this year, employers, when they're filling out their tax information, will look back to 2014, count their employees, and that will determine if they're subject to the large employer penalty for 2015. And for 2015, there's some transitional relief, which means that whether the employer has at least 100 employees for 2015. For 2016, that'll be 50 employees. So folks who may be in that 50 employee spectrum should be thinking about that, because that penalty will apply for the 2016 calendar year. So if you have fewer than 100 employees in 2015, 100 FTEs, then you're fine. You are considered a small employer, and you will not be subject to this penalty, this federal penalty, although you may be subject to the Vermont employer assessment. If you actually have at least 100 FTEs, then you'll move on to the next thing. Although what I should point out is this transitional relief of 100 FTEs only applies to employers who did not reduce their workforce. So if you are an employer who reduced your workforce and there was no legitimate business reason for doing so, then you may still have to pay the large employer penalty. Once you've determined that you're a large employer, the next step is to figure out if you offer the health insurance to enough of your full-time employees. So for 2015, you have to offer health insurance to at least 70% of your full-time employees and their dependent children. If you don't do that, and at least one full-time employee receives a premium tax credit or cost-sharing subsidy in Vermont Health Connect, then the employer must pay a penalty for not offering coverage. And that penalty will be $2,084 per year, minus 80 employees. Again, that 80 employees is transitional relief for 2015. For 2016, that number will go down to 30 employees. So if you have offered coverage to at least 70% of your full-time workers and their dependent children in 2015, the next question is the insurance adequate? Is it at least as good or better than a bronze plan in Vermont Health Connect? And if the answer is no, and you have an employee to get a premium tax credit or cost-sharing subsidy, then the employer would be subject to a penalty of either $3,126 per year or $2,084, whichever is less. The employer who offers coverage will never have to pay more than an employer who doesn't offer coverage when it comes to this penalty. So if you have if you provide adequate insurance, the next question is, do you contribute enough to that insurance to make it affordable? So if you have any employees who pay more than 9.56% of family income for the employer coverage, then you may be subject to the penalty. Now, a lot of employers are concerned about figuring out what family income is. There are several safe harbors for employers for this, and the sort of safest harbor, I think, is the as long as the employer contribution ensures that the employee is not paying more than 9.56% of W-2 wages for self-only coverage. So if you contribute enough so that the employee is not paying more than 9.56% of their own wages that you pay them for self-only coverage, then the employer is safe. And so if that's the case, there's no penalty. But if the employee pays, 10% and the employer is not contributing enough, and they're paying 10% of their wages for healthcare coverage, then the employer will be subject again to that penalty if the employee receives a premium tax credit or cost sharing reduction through Vermont Health Connect. And that penalty is the $3,126 per year for each employee receiving a premium tax credit, or $2,084, whichever is less. A couple other forms of relief as we go through this transition that the federal government has provided for folks is that it's okay for employers who previously had a non-calendar plan as of December 27, 2012. They can stay on their non-calendar plan. So if an employer had a plan that started in October of 2014 and has gone through to October of 2015, even though the large employer penalty applies for this year, they can get a plan that fits into the law in October. Again, they have to be on a non-calendar plan as of December 27, 2012, though they couldn't have just started to get on the non-calendar plan as of last year. So if you're not on your typical January to December plan, you sort of have this year to transition, and then once you transition into that, you will have to follow the requirements to avoid the large employer penalty if you are a large employer. Another piece of transition for 2015 is that employers will not be liable for failing to offer dependent coverage if the employer previously did not offer dependent coverage and the employer takes steps during the 2014 or 2015 plan year to extend coverage to dependents. So a lot of the sort of theme with the transitional relief is as long as the employer is acting as a good actor and following these sorts of things, then they'll be eligible for the transitional relief. So if the employer had offered dependent coverage in 2014 and then dropped it for 2015, they don't get this relief. But if the employer previously had not offered dependent coverage, they sort of get a year of breathing room before they're required to offer that coverage. So if you're a large employer and you either don't offer coverage or your coverage is unaffordable or inadequate, the employer will make a shared responsibility payment after April 15th. So for the 2015 year, that payment would be made after April 15th in 2016. And that's because the IRS must determine if the employee took the premium tax credit. So in the previous slide, we saw that the employer is subject to the penalty only if one of the employees took the premium tax credit. The IRS needs to figure out if that actually happened, and that's done through personal income taxes. And so all that information has to come in before the IRS can actually contact the employer about paying the penalty. The employer is not required to include the payment on the tax return. The IRS will send a notice and demand for the payment. So that's the large employer penalty. Another thing in effect for 2015 is employer reporting. And employers may have heard about 1095Bs, 1095Cs, 1094Bs and Cs. And these are new tax forms to show that employees had coverage. On the 1095B, that is a form that insurance companies will provide. So insurance companies and small employers that are self-insured will file these forms with the IRS. If you are an employer who gets your insurance through the exchange as a small employer, actually if you're a small employer this doesn't apply, so don't listen to that example. But if you're an employer who gets your insurance from a typical insurance company and you're not self-insured, your employees will get these 1095B forms. If you are, if you're a large employer and you are, well, if you're a large employer, you will fill out a 1095C form, and whether or not you are self-insured will determine how much you actually have to fill out on the form, and we will get to that in the next slide. And for the form 1094Bs and 1094Cs, these are the transmittal forms. They sort of aggregate all the information of your employees, and those are sent to the IRS. And I should go back to the 1095B healthcare coverage. Small employers that are self-insured will have to file these forms. Small employers who are getting health insurance through Vermont Health Connect, the health insurance companies will actually send these forms, these 1095B forms, out to the employees. So small employers getting health insurance through Vermont Health Connect don't have to worry about filling out a form. They will, those forms will be sent out from Blue Cross Blue Shield or MVP out to the employees. So who reports for reporting purposes? Large employers are employers with 50 or more FTEs. And so large employers have to do that 1095C form, whether they're self-insured or getting insurance from an insurance company. And even though for 2015, the employers with 50 to 100 employees are not subject to the large employer penalty, they will still have to report. So if you are at that 50 FTE threshold, you may have to fill out a 1095C and a 1094C. The way to count the number of employees is to get the average of full-time employees and FTEs from the previous year, and count them that way. And you count all the employees under common control. So Tracy answered a question about what if you are one owner but you have several different businesses, how do you count those employees for purposes of Vermont's employer assessment? With this case, under the federal law, if you're one owner and you have several businesses, you count all the employees under your common control. And so it's possible that businesses may be considered large employers even if they have just a couple small companies or small employer companies that are owned under one person. So you can see here what folks will have to file depending on whether they're insured or self-insured, or if they're a small employer or a middle employer or a larger employer. Employers with fewer than 50 employees will have to file 1095B. If they have health insurance that they offer to their employees, the insurer files that 1095B. If it's a self-employed or a self-insured small business, then the employer files that 1095B. So small employer who gets insurance through the insurer will take care of that 1095B. The small employer will not have to worry about it unless the small employer is self-insured, which very few small employers are. The next part is the most important part because it could potentially slip through the cracks. The employers who are considered large employers normally but are sort of benefiting from this transition period under the Affordable Care Act and have fewer than 100 employees still do have to do reporting. And so if the employer has an insured health plan that they offer, they will fill out parts 1 and 2 of the 1095C, and the insurer will file the 1095B, which sort of takes care of that part 3 of 1095C. If the employer that has between 50 and 99 FTEs is self-insured, they will fill out 1095C parts 1, 2, and 3. And then the same goes for the employers who have 100 or more FTEs. That employer, if they have insurance through an insurance company, they will file Form 1095C and just fill out parts 1 and 2, and the insurer will fill Form 1095B and send that out. And then for the large employer who is self-insured, the employer files the 1095C and fills out parts 1, 2, and 3. And here are some resources for folks to get more information. The Department of Labor has an excellent page on the healthcare contribution / Vermont employer assessment, and then the Kaiser Family Foundation is always a good place to get simple information about the large employer penalty, and then the IRS is great for more in-depth conversation. And it looks like we have some questions, so I'm going to go to here. See if I can toss this out. Okay. So we have a question here from Christina where she's asked, if I understand you correctly, it really doesn't matter if an employee is seasonal or part-time because an employer still needs to include their hours when they have no coverage or Medicaid. And that is correct. Tracy can jump in and correct me at any time, but yes, that's true. The only sort of exception for the seasonal or part-time employees is if they have other coverage or if they have coverage through Vermont Health Connect. Would you agree with that, Tracy?
I do agree with that.
Okay, and the next question is, how does this apply for businesses like Jim just asked about, separate EINs, the same 100% common owner? If each business is under 50 but together are over 100, how is this treated? I am guessing that this is for the large employer penalty, that shared responsibility payment, the federal penalty under the Affordable Care Act. And so, as I mentioned, it's possible that businesses treated separately, I believe it's possible, and Tracy can correct me if I'm wrong, that businesses treated separately for the Vermont employer assessment could be considered one business under the Affordable Care Act if they are businesses under common control, and it's that IRS definition of common control where basically if they're the same owner, regardless of if it's a gas station and a laundromat and a car wash, which are very different businesses. But if you have that situation where one owner owns all of those businesses, you would have to count all the employees in those businesses, and you could potentially be over the 50 or 100. And then someone asked, can we receive this PowerPoint presentation via email? I'm going to leave that up to Jim, but I don't see why not.
Yes, no, we're happy to share that and provide a link on our website. And Devin, I just asked that you give me the latest version because I think you sent me an earlier version before. Maybe it's the same.
Yes, I will do that. I will send you the version that we are using right now once we're off the call. So that's all I have. If there are any other questions, I talked to Jim a little bit beforehand. If folks have questions about the soft drink tax, I'm happy to answer those while I'm on the line. I've been working with the Department of Taxes as well, so I might be able to answer some of those questions. But I do urge people to check out the Department of Labor website for the employer assessment. It has what looks like a pretty intimidating flow chart, but it's actually very helpful and does sort of do a lot to clear up a confusing law.
We have also posted on our website, vtrga.org, not only the updated links on the new soft drink tax and some related copies or documents related to that, as well as the recording, a link to the recording of the June 16th webinar. But we are also posting under healthcare, under resources, the connections, the links to the Department of Labor website on the employer healthcare contribution information, and that decision tree, HC4, I think it is, Tracy, is linked there. And while it may give you a headache when you first look at it, it really is a handy reference guide. If you go through each question and answer yes or no, it will lead you to the next options, and then you can get to a point where you determine if each employee needs to be counted as part of your uncovered employees or not.
Okay, I'm not seeing any more questions.
Well, thank you, Devin. Thank you, Tracy. And thank you, members who joined the call. Hopefully this was helpful. And if there are other topics that you would like to see covered in the future, please let us know, and we will do our best to work with various agencies to bring those to you.
Thank you, Jim.
Right. Thank you.